Learning objective 5, prepare the financial statements for service, merchandising, and manufacturing companies. As an example here, we have a service company income statement. What do we notice about a service company income statement? What's relevant, what's most obvious is you do not see cost of goods sold here. There's no cost of goods sold because there's no product that is sold. You have revenues, and then you have operating expenses, which includes salary, office rent, depreciation, marketing expenses. We add those up and we come up with our total operating expenses. So revenues less the operating expenses are going to give us operating income for a consulting company. A merchandising company, that income statement is going to be a little bit more sophisticated, a little bit more complex. The income statement is going to be listed here. We're going to have sales, but one thing to recall, I'll go back. If you look at, this is revenues or service revenue, right? There's no reference to sale because you didn't sell anything. So a service company doesn't have any sales, they have revenues. In most cases, it's going to be called service revenue. When we look at a merchandising company, the merchandise company is going to start off with sales revenue. Okay, in this example here, it's $150,000. Less cost of goods sold. Well, this is a merchandising company. This is a wholesome foods. So they are buying product and they're turning around and selling it. So the cost of goods sold is the cost of the product that they're selling. In this example here, it's $106,500. Their gross profit is the difference between the sales revenue and the cost of goods sold. That is their gross profit. The gross profit is $43,500. From there, we're going to subtract the operating expenses, including salary and wages, rent, utilities, marketing. So these operating expenses look a lot like what you would see on the operating expenses of a service company, but they're broken out separately so that we can separate them from the cost of goods. When we're looking at the merchandising company, we have to remember this basic formula we learned in Accounting 1. We have our beginning inventory, what we started off with for that period of time. We're going to add to that any purchases, freight in and import duty costs, which include, in this example here, are $110,000. And we add these two together to give us the goods available for sale, the cost of the goods available for sale. From there, we subtract our ending inventory. And then by default, that must give us the cost of goods sold. Hopefully you remember some of that from financial accounting. We're going to review perpetual inventory systems. A perpetual inventory system. In my classes, when I teach this in financial accounting, I suggest to you that when you think of perpetual, think of technology, things that happen on a real-time basis. So inventory labeled with unique barcodes that reflects the sale price to charge customer and the product cost to the merchandiser, so that every time barcode is scanned, accounting records are automatically updated. So perpetual inventory systems mean inventory records are automatically updated. All right. So that means we have the sales revenue earned, we have the cost of goods sold, and we remove the product from the inventory. So, you know, when you think of a place like Walmart or Target, Best Buy, as you're checking out, they're running their products through barcodes while they're immediately updating their inventory records. That is what we refer to as a perpetual inventory system. A periodic system, on the other hand, you don't get that kind of sophistication. In a periodic system, we're talking about how we're not even going to worry about inventory until the end of the period. And then we're going to go do a physical count. What do we have in inventory? So we have all our purchases, we have our beginning inventory, we purchase everything during that period, and it's just added to the inventory. And then at the end of the period, we go in and then take a physical count of what we have left over. And that dictates how much inventory we have. Not what a barcode system tells us, but what we physically count. Now, and when we do this, we're going to be accounting for any breakage, theft, input errors, or obsolescence. What's the point? The point being is that even if you're using a perpetual system, at some point in time, you're going to have to do a physical inventory, because the perpetual system is not going to be taken into consideration maybe some of the things like breakage and theft and input errors and obsolescence. So even if we're using a perpetual system, as we described in the previous slide, at some point in time, we're going to have to do a physical inventory to make an adjustment for these items. Well, the good news is that we don't even have a perpetual inventory system. We're just using a periodic inventory system. So therefore, at the end of the period, we're just doing a physical count every time. This is a bit archaic, and you might even wonder, why would anybody have anything like that? But there are circumstances where it does make sense. And if you were in my financial accounting courses, you remember, hopefully you remember what we talked about then. Lastly, we have a manufacturing company income statement. This is going to look a lot like what you would expect to look for a merchandising company. Sales revenue, sales, cost of goods sold, gross profit, looks a lot like the merchandising income statement, operating expenses, and operating income. Now, the difference is that now when we're talking about calculating the cost of goods sold, there are several steps to doing this. For a merchandising company, there was really just one schedule that got you there, right? One schedule, you figured out what the beginning, you added any purchases, you had the goods available for sale, you subtracted your ending inventory, boom, you were good to go. In a manufacturer, it gets a little bit more complicated. We're going to first figure out what our calculation of direct materials used is. That's not even cost of goods sold yet. We're going to start off with beginning raw materials inventory. Kind of looks like what we just looked at, but now we're not just talking about goods that are being sold, we're talking about our raw materials. So we have our beginning raw materials inventory, we have purchases, which now gives us the materials available for use. We're going to subtract from that our ending raw materials inventory, and then that gives us what the direct materials used is. Now, that doesn't mean we've sold any of this. This is how much has actually been used. Used for what? To manufacture our product. When we manufacture our product, after it gets taken out of raw materials inventory, it goes into work in process. So now the next schedule is analysis of the work in process inventory account. Well, just like our previous schedule, we're going to start off with the beginning work in process inventory. This is what was on the floor, already started to be produced, ready to go, but never really finished. We started off the year, we shut the lights off at midnight on December 31st, and there's some product still on the floor that's not finished. We'll come back the next morning, January 1st. Oh, we'll probably get that day off. We'll start January 2nd and turn the lights back on, and now we've got some product that we still need to finish, right? Well, our beginning work in process inventory reflects that what's still on the floor. Then from the beginning work in process, we're going to add to the direct materials used. I bet we got this 14,000 from where? You guessed it, from the previous slide. Direct materials used, that 14,000 carries over to the next slide. Direct materials used is right here. So we start off with beginning inventory work in process of 2,000 in this example. We're going to add to that the direct materials used carried forward from the previous schedule. We're going to add to that any direct labor. We're going to add to that any manufacturing overhead. And then that gives us the total manufacturing cost to account for. That's $47,000 of cost to account for. From there, we're going to subtract what our ending work in process is for this period. And then that's going to give us the cost of goods manufactured, or what we call CGM, cost of goods manufactured. But wait, there's more. We have the calculation of cost of goods sold. Now finally, on the third schedule, we're finally going to get to the cost of goods sold. How do we account for that? So we have beginning finished goods inventory. These are products that are sitting on the shelf ready to be sold, but they haven't been sold yet. They were manufactured. They weren't purchased. They were manufactured. They're sitting on the shelf. When we started this period, we had 6,000 on the shelf. We're going to add to that the cost of goods manufactured, 42,000. I wonder where that came from. You guessed it, it came from the previous slide. Cost of goods manufactured, 42,000. Bingo, that's where that came from. We're going to take the beginning finished goods inventory. We're going to add to that the goods manufactured, the cost of goods manufactured from the previous slide. And that's going to give us the total goods available for sale. We're going to do a physical inventory of our ending finished goods inventory. And then that's going to be finally, after 3 schedules, we come up to the cost of goods sold. In this example here, it's $40,000. That's how the income statement works. Now let's take a look at how the balance sheets look when we refer to a service company, merchandising, and manufacturers. So just quick notes here, service companies have no inventory. So you're not going to see a reference to any inventory on a service company. A merchandising company does show inventory and will have merchandise inventory. The manufacturing company will also have inventory, but it's going to be much more sophisticated, broken down into more detail. Manufacturing companies are going to show raw materials, work in process, and finished goods inventory. Those 3 items are going to really be made up of inventory, but broken down in more specific areas. Objective 6, describe costs that are relevant and irrelevant for decision making. 2 more terms we want to understand and study a bit and make sure you have that understanding, because that will be very helpful for your quizzes, for your homework, for your quizzes, and for the exams. Controllable versus uncontrollable costs. Controllable costs are costs that management is able to influence or change. Now that may seem kind of weird. That may seem kind of weird because you're thinking, well, can't management control all costs? And at some point in time, that has some validity to it. But there's going to be some costs that really, for a period of time, they have no control. So for example, let's say a company signs a 5-year lease to rent or lease a manufacturing building. Well, every year, the company has to pay lease expense. Let's say it's $1,000 a month. So let's say we're in year 3 of a 5-year lease. Well, when you're writing those checks out in year 3, you're charging those costs to rent expense. The lease was signed 3 years ago. The current management has no control over that. You have to abide by that lease because it's going to be too expensive to get out of that lease, potentially, I mean, depending on the circumstances. But for the most part, unless there's some extraordinary circumstances, those costs are not going to be considered controllable costs anymore. They were signed 3 years ago, and we can't really yell or scream or get upset with management on those costs because, you know, they're obligations that were made 3 years ago. In that example, a lease signed 3 years ago, that's uncontrollable costs. Cost companies are locked into in the short run. That lease is a 5-year lease. That, you know, now the next lease that they have to sign after year 6, yeah, that's going to be back in control. But in the meantime, those are going to be costs that are uncontrollable. Most other costs, though, most costs are really going to fall under controllable, and those controllable costs are a cost that management is able to influence or change. The concept of relevant and irrelevant costs. Relevant costs are going to be costs that will differ, or the way the textbook is writing it here, differential costs differ between alternatives. You have option 1 and option 2, maybe 3, 4. You have various options. The costs that will differ between those options, those are considered to be relevant. So irrelevant costs are costs that do not differ among alternatives. In this case, the term that we're going to look at more specifically is called sunk costs. That's an example of an irrelevant cost. The costs that have already been incurred and cannot be changed. You fixed your vehicle last year and you spent $10,000 putting a new transmission. Now you're trying to figure out whether you should continue to put another $5,000 into that vehicle. Unfortunately, the costs that you spent last year are really not relevant on how much you should spend this year. It doesn't always feel that right. Sometimes it feels like we should be accounting for it, but we can't. Costs that have been incurred, water under the bridge, that doesn't make a change or difference into our decision-making process. Okay, learning objective number 7, we're going to talk about classifying costs as fixed or variable and calculate total and average costs at different volumes. Another concepts, or these terms are going to be used in future chapters, so you really want to get a hold of these. Fixed costs. The concept of a fixed cost is a cost that stays constant in total over a wide range of activity levels. The example here is if you have a car, it doesn't matter whether you drive 0 miles or you drive 10,000. The insurance for that car is going to be pretty much the same, between 0 and 10,000. I guess if you go up to maybe 15 or 20,000 miles, that may make a difference. But within this range of activity level, you drive it 1 mile, it's going to cost you 1,788. You drive it 10,000 miles, so this is a fixed cost. The activity levels, even though they're going up, they don't change. Those costs will not change. Those are considered to be fixed costs. Variable costs change in total in direct proportion to the change in volumes. So let's take that same vehicle and we talk about driving 0 all the way to 10,000 miles. Well, what will change is the gasoline costs. So as you drive more miles, your gasoline costs will go up. That's what we refer to as a variable cost. It will change. Those are costs that will change in total in direct proportion to the change in volumes. The concept of fixed versus variable leads us to a discussion about cost behavior. Costs behavior. They do have behavior. Costs do behave in a certain manner. And what we're trying to do is really make our lives a little bit easier. Believe it or not, there's so much complexity in here to try to narrow down things, and what we're trying to do is make it so that we don't have to analyze every single penny about everything that we're doing. If we have direct materials, as an example, we're going to consider a direct material a variable cost. Those are costs that are going to go up with the number of units we sell. That's going to be a variable cost. We're going to add to that direct labor. Well, direct labor would also be considered to be a variable cost. Direct materials, direct labor, they go up in direct proportion with the volumes. The more volume we have, the more these costs in total are going to be. Manufacturing overhead, though, that's going to be made up of both variable and fixed costs. When we say that they are really a mixture of fixed and variable costs, we're going to take our direct materials variable, direct labor variable, manufacturing overhead that's made up of both variable and fixed, and that's going to give us our total product costs. And that's what the suggestion is our total product costs are really made up of a mixture of fixed and variable costs. So let's take a look. Total costs are really made up of total fixed plus variable cost per unit times the number of units. Variable cost per unit times the number of units. The example here is we have fixed costs of $20 million. Our variable cost per unit is $5,000 per vehicle. The number of units is 10,000. Well, can we figure this out? Can we figure out what our total cost is? I think we can. We're going to take our total cost is made up of our fixed. Well, we know what our fixed is. They gave that to us. We're going to add to that our variable costs. and this is a variable cost per unit, and then we're going to multiply it by the number of units. $5,000 multiplied by 10,000 units. We're going to use the order of operation here. What we saw first is what is in parentheses. 5,000 multiplied by 10,000, that's going to give us 50 million. 50 million, we're going to take 50 million and add to that 20 million. And that's going to give us a 70 million. Fixed plus variable gives us our total costs. An average cost is going to be an important concept. We're going to take our average cost is computed by taking the total cost and dividing it by the number of units produced. So using our previous example, our total cost was $70 million. We're going to divide that by 10,000 vehicles, 10,000 units. That means that our cost per unit, or our average cost per unit, is 7,000 per vehicle. Marginal cost, the term marginal, this is used in business all the time. These are terms that you really want to know, because you're going to be sitting in management meetings and somebody's going to use this cost, and if you're not on top of it, you'll miss out. Marginal cost, the cost of making one more unit. Okay, one more unit. So when we're talking about, let's say we've already produced 10,000 units, and now we're trying to figure what's it going to cost us for that next unit, that 10,001 unit, just the one unit above the 10,000. What's it going to cost us? Well, fixed cost will not change if one more unit is made. Fixed cost, the rent, is not going to go up if we're just going to produce one more unit. So the fixed costs will not change. So we're really looking at just the costs that will change. More specifically, fixed costs will not change if one more unit is made unless the plant is already operating at 100% capacity. So that, I mean, if you're at 100% capacity, you're going to have to go lease another building. Unless you're at 100 capacity, your fixed costs will not change. Okay, that concludes chapter 2.